You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive, your shortcut to cutting through the noise and really understanding the complex currents shaping our world.
Absolutely.
Today, we're asking a pretty big question. Are these global currents pulling us towards, say, greater collaboration?
Or something else entirely.
Or are we seeing a more fragmented world where, every nation charts its own course, often quite independently?
It certainly feels like a mix sometimes.
We're going to dive deep into the latest headlines, looking at trade, currencies, commodities, geopolitics.
All the big movers.
And we'll try to extract the most important nuggets of knowledge and insight for you.
Right. The goal is to help you feel genuinely informed, but without that sense of just being overloaded with raw data.
Exactly.
That's right. We've synthesized a whole range of sources for you, and what really keeps jumping out is just how interconnected everything is. You see a shift in one area, trade, for example, and it inevitably ripples into currencies or geopolitics.
No doubt.
Our mission really is to connect those dots for you, reveal those kind of hidden implications.
And give you that aha moment.
Hopefully.
Okay, let's unpack this then. Starting with some pretty big moves in trade policy that have, they certainly captured headlines.
Semiconductors being a big one?
Yes. President Trump announced substantial tariffs on semiconductors are coming very shortly. But here's the twist, isn't it?
There always seems to be one.
He reportedly reassured major U.S. technology companies like Apple that they will not be directly targeted.
Right.
Which sounds like a precision strike, maybe?
Yeah.
But for an industry as global and interconnected as semiconductors, is precision even truly possible?
That is the critical question, isn't it?
What are the ripple effects beyond those immediate targets?
And it really gets to the heart of modern industrial policy. On the surface, it looks strategic, right? Aiming to boost domestic production without directly hurting your own tech giants.
Sure.
But the semiconductor supply chain, it's just notoriously intricate. It's global.
Incredibly complex.
Exactly. So the key insight here, I think, is that this isn't just about tariffs. It's a really profound statement about national security, about economic sovereignty.
Trying to force reshoring.
Precisely. Forcing that critical manufacturing back home. But the unexpected ripple, it could be in how it forces all those smaller global component suppliers to make some really tough choices.
Oh, okay.
Which could potentially make the very supply chain it aims to secure even more complex, maybe more brittle, at least in the short term.
So less secure, potentially.
It could inadvertently speed up a more fragmented, maybe less efficient global production system. Yeah.
So paradoxically, it could create more bottlenecks, not fewer, even for the companies that were supposedly protected initially.
It's certainly a risk. That's quite a nuanced consequence, isn't it?
It really is. And okay, while those semiconductor tariffs are looming, Washington also formally implemented a pretty significant trade deal with Japan.
Right, that one moved forward.
This agreement sets a 15% tariff baseline on most Japanese imports. That's the headline number. And in return, Tokyo made some, considerable commitments, including a significant increase in rice purchases.
Always important politically.
And a multi-year investment package valued at $550 billion. That's a huge number.
It is a very significant commitment.
Japan's Prime Minister Ishiba apparently emphasized minimizing economic impact, and the negotiator, Akazawa, noted consistency with earlier agreements.
Trying to smooth the waters.
And they mentioned auto tariff reductions should take effect within 2 weeks.
Yeah, this deal with Japan, it's not just a simple tariff tweak. It's more like a blueprint for bilateral certainty, especially when the global trade environment feels so uncertain.
Shoring things up.
Exactly. If we connect this back to our big question about collaboration versus fragmentation, this is a clear example of nations actively strengthening specific alliances, securing strategic advantages, particularly when those bigger multilateral frameworks seem under strain. And the sheer breadth of the deal, you mentioned agriculture, investment, industrial goods, it really underscores a shift towards these more bespoke, comprehensive agreements.
Tailor-made deals.
Exactly, serving broader geopolitical goals that go way beyond just simple market access. It highlights a preference for these deep, reliable partnerships.
That makes a lot of sense. And we're seeing this kind of proactive reevaluation, maybe, extending beyond just these huge agreements.
Seems like it.
Mexico is reportedly weighing tariffs on imports from countries without trade agreements, including China.
Another interesting move.
Then Ecuador is pursuing a new trade agreement with the United States following high-level meetings.
Right.
Is this a broader global trend then? Countries basically just actively redrawing their trade maps?
I'd say absolutely. These aren't just isolated incidents. What we're seeing is a widespread, almost, you could say, feverish reevaluation of trade relationships all over the world.
Wow.
Nations are increasingly prioritizing their own national interests, supply chain resilience, strategic alliances, you name it. It really suggests a departure from that previous era of broad multilateralism, doesn't it?
Towards something else.
Towards a more fragmented, maybe bilateral or regional approach, where countries are trying to lock in more favorable terms, protect the domestic industries, and, solidify those strategic partnerships in what feels like a very dynamic and sometimes pretty unpredictable global trade environment.
So the economic landscape is definitely, shifting underfoot. Okay, these shifts in global power dynamics, these redrawn trade maps, how do they then echo through, the very lifeblood of the global economy?
Currencies.
It's currencies, exactly. Let's dive into what's been happening there. The U.S. dollar, for instance, eased slightly overnight.
Just a bit.
As traders apparently braced for the U.S. jobs report.
Always a big one.
And this comes after recent weaker job indicators and dovish commentary from the Federal Reserve.
Right.
So why do things like the jobs report and, signals from the Fed have such immediate sway over something as huge as the dollar?
Indeed. It's a classic case, really, of market anticipation directly hitting currency values. Traders are just incredibly sensitive to economic data points, especially job reports, because they're often seen as leading indicators for what the Federal Reserve might do next with interest rates.
The Fed's next move.
Exactly. And when you hear dovish commentary from the Fed, well, that means they're signaling a more cautious stance, maybe less aggressive on rate hikes, usually because the economy seems to be softening a bit.
Right.
And higher interest rates typically strengthen a currency, right? Because they make it more attractive for investors seeking yield.
Sure.
So any hint the Fed might pause or slow down those hikes, it tends to cool off demand for the dollar. It's all about the market trying to guess the Fed's next play.
That immediate reaction, it makes perfect sense when you put it like that.
Okay.
Moving across the Atlantic, the euro, it regained a footing above the 1.16 level.
Climbed back a little.
Though it says momentum was limited by a lack of fresh catalysts from the eurozone.
Nothing new driving it.
Meanwhile, sterling, the British pound, held steady with participants awaiting UK retail sales data. Sounds like Europe's kind of in a holding pattern.
That's a good way to put it, precisely. Both the euro and sterling are pretty stable right now, but without significant new economic data or, big central bank announcements, we'll call catalysts, traders are just hesitant to make big bets.
Waiting for a signal.
Everyone's waiting for that next piece of info, whether it's UK retail sales or something new from the European Central Bank to kind of guide their decisions.
Okay.
It really highlights how important these specific economic releases can be. They act as critical turning points for currency direction, especially when the overall picture isn't totally clear.
Now, here's where it gets, I think, really interesting and maybe a bit surprising. The Japanese yen. It strengthened modestly.
Okay, against the trend maybe.
And the key reason cited, Japanese wage data showed the fastest growth in 7 months.
Wages.
And even more significantly, real earnings turned positive for the first time since January. Now, we've talked endlessly about Japan battling deflation for decades.
For so long, yes.
What's the deeper significance of these numbers for its currency and maybe even beyond that?
This isn't just your standard economic data point moving a currency slightly. This could be a potential historical turning point for Japan.
Really? That's significant.
I think so. For a country that has fought deflation and stagnant wages for, well, it feels like forever.
Yeah.
Positive real earnings for the first time since January. That signals a potential escape velocity from that long-standing trap.
Yeah.
If this trend actually holds, it doesn't just make the yen more attractive by signaling, an improving economic outlook. It could fundamentally reshape the Bank of Japan's ultra-dovish monetary policy.
A huge policy shift.
Potentially echoing a shift that could, frankly, redefine Japan's economic trajectory for years to come. That's the real story here. I think a potential unwinding of assumptions held for decades.
That's quite an insight. Incredible how a single wage report can carry that much potential weight.
Context is everything there.
Okay, finally, in currencies, we saw the antipodian currencies. That's the Australian and New Zealand dollars.
Aussies and Kiwis.
They posted slight gains alongside generally constructive risk sentiment. But their upside was capped by the absence of domestic data.
Right.
What exactly is constructive risk sentiment, and why does it particularly influence these specific currencies?
Yeah, constructive risk sentiment is basically just trader jargon for when investors are feeling generally more optimistic about the global economy.
Okay, feeling good.
Feeling a bit more willing to take on risk. It's a general sense of optimism, really. And currencies like the Aussie and Kiwi dollars are often seen as proxies for global growth.
Because of commodities.
Exactly, because their economies are heavily tied to commodities and global trade. So when that global risk sentiment improves, these growth-linked currencies tend to benefit.
Makes sense.
However, their gains were limited this time because without specific positive news coming out of Australia or New Zealand themselves.
No local fuel.
Right, without that domestic data to reinforce the optimism, traders only push them so far. It shows that while those big global tides matter, the local currents are still essential for any sustained movement.
So financial markets clearly reacting to both, economic tea leaves and that broader global feeling.
Definitely.
But those very currency fluctuations, those geopolitical rumblings we've touched on, they often directly impact the raw materials that fuel our entire global economy.
Commodities, yeah. The building blocks.
How are things looking there right now?
Well, from currencies, let's definitely turn our attention there to those essential resources. Commodities. Crude oil, for instance, was little changed.
Stable for now.
After some recent declines, which were tied to speculation over OPEC's next move.
Always OPEC.
Always. Russian Deputy Prime Minister Novak, he stressed that no production increase is currently under discussion ahead of Sunday's OPEC Plus meeting.
Okay, trying to calm the market.
Seems like it. Though he did add the group continues to evaluate conditions carefully, which is, standard language.
Right. Keeps options open.
This is that intricate dance you always see in the oil markets. Statements from key players like Novak are just scrutinized incredibly closely.
Every word matters.
Because they can heavily influence price expectations. The market's trying to read between the lines, constantly balancing official statements against actual production data and, forecasts for future demand.
And speaking of production, the data showed August output across the cartel actually rose by 360,000 barrels per day.
So production did go up.
Even though they say overall compliance rates remaining strong.
Which sounds a bit contradictory.
It does. And adding to that, U.S. government inventory data showed a surprise build in crude stocks.
Yeah.
More oil than expected in storage.
Right.
Which also tempered demand sentiment. So, okay, we have conflicting signals here. Novak says no increase planned, but actual production rose and U.S. stocks built up. How do you reconcile that complexity when trying to understand where oil prices might go?
Yeah, it creates this fascinating tug of war for oil prices, doesn't it? On one hand, Novak's statement is clearly designed to create price stability, signal discipline, keep prices supported.
Right.
On the other hand, the actual rise in OPEC Plus output and that surprise build in U.S. crude stocks, well, they both point to a pretty robust supply picture right now.
Supply looks healthy.
Exactly. So the crucial takeaway, I think, is that the market constantly balances that perceived supply discipline from the statements against the actual supply figures and demand indicators.
Perception versus reality.
Kind of. So while compliance within OPEC Plus might be strong relative to their specific targets, the overall increase in output combined with higher inventories, it suggests that the supply side might be comfortably met for now.
Okay.
And that tempers demand sentiment, keeps prices in check, despite those verbal reassurances. It's less about any single data point and more about the overall narrative that emerges from these often contradictory signals.
That's a really great way to put it, the narrative. Okay, shifting focus slightly, but still on energy. Russia's broader strategy. Rosneft confirmed it will expand supplies to China through Kazakhstan
strengthening that route.
and is working to boost capacity on the Power of Siberia pipeline.
Also aimed at China.
How do these infrastructure projects, these supply developments, tie into that bigger geopolitical picture and Russia's own energy security strategy?
Well, these moves really highlight Russia's very deliberate, very long-term pivot towards Asian markets, particularly China.
Pivot to the east.
Exactly. It's a strategic diversification away from their traditional European markets, which, let's face it, aligns perfectly with that global reevaluation of alliances we were discussing earlier.
Right, building new partnerships.
Expanding supplies through Kazakhstan, boosting pipeline capacity. These are critical steps in securing energy security for its partners, like China, and deepening those geopolitical ties. It's effectively rerouting global energy flows and helping solidify a new kind of energy access. It's not just commercial, it's deeply strategic in a world where energy security is absolutely paramount.
Okay. In other commodities, briefly, gold is holding above $3,500 per ounce ahead of the U.S. employment report, holding steady.
A key level there.
While copper firmed in step with improved Asian risk appetite.
Copper liking the optimism.
What do these movements tell us quickly about broader market sentiment?
They act as pretty clear barometers, actually.
Yeah.
Gold often serves as that safe haven asset, right? So its stability above that key price point, especially ahead of a big report like the U.S. jobs figures, it suggests a kind of cautious optimism, or at least a stable outlook while everyone waits.
Okay, cautious.
Copper, on the other hand, being an industrial metal, it tends to firm up when risk appetite improves, particularly in Asia.
Because it signals growth.
Exactly. It reflects expectations of increased economic activity, more demand for construction, manufacturing, that kind of thing. So they both kind of echo the broader market's delicate balance right now between hope for growth and some underlying uncertainty.
Okay, so we've navigated the intricate dance of trade tariffs, the subtle signals in currency markets, the push and pull of energy supplies.
Been quite a journey already.
What does all this mean for the even bigger, arguably more complex global picture? Let's turn our attention now to the challenging arena of geopolitics, where all these currents truly collide.
Indeed. This is where those themes of collaboration versus fragmentation really play out, often in stark ways.
Starting in the Middle East, reports indicate the Israeli Defense Forces now control 40% of Gaza City.
A significant military development on the ground.
Simultaneously, though, U.S. envoy Witkoff met Qatari officials in Paris to discuss a possible hostage deal aimed at ending the conflict.
So diplomacy is also active.
We see these military developments happening alongside diplomatic efforts. What are the immediate challenges and maybe the longer-term questions raised by this kind of dual approach?
Well, this situation raises an incredibly complex question, doesn't it, about the path forward and the interplay between military objectives and diplomatic leverage.
How they interact.
Exactly. The military advances on the ground are undeniably significant, but they're happening at the same time as these urgent, high-level diplomatic efforts aimed at some kind of resolution, specifically focusing on a possible hostage deal.
Right.
The real challenge lies in how these two tracks, military action and negotiation, can possibly align, or if one undermines the other, or if they can somehow create conditions for a durable peace.
A huge challenge.
It underscores the immense difficulty of finding diplomatic solutions when conflict is actively ongoing, and that constant search for just a window, any window, for de-escalation.
Okay. Moving now to the Russia-Ukraine war. President Trump stated that he will soon speak directly with President Putin, insisting the conflict will be settled.
A very direct statement of intent there.
There are also reports that the U.S. plans to cut certain security funding for European states bordering Russia.
Ah, that's interesting.
In a move apparently intended to push NATO allies to shoulder more of the defense burden.
Putting pressure on allies.
This sounds like a multi-pronged approach from the U.S. side.
Yeah.
How does this intention for direct talks alongside this pressure on NATO allies balance with, well, the Kremlin's own stated positions?
Yeah, it's really vital to look at all the perspectives here to understand the dynamics. President Trump's statement signals a clear push for direct dialogue, aiming for a swift resolution. That's one track. However, the reported plans to cut security funding for some European states, that's not just about, tightening the budget. It's a very clear signal to NATO allies to step up their own defense spending.
Burden sharing.
Exactly. Potentially reshaping the entire burden-sharing dynamic within the alliance, which could, frankly, create some internal friction within NATO at a pretty critical time. Then you have the Kremlin's view. They've reiterated that security guarantees for Ukraine cannot come from foreign troops, and they've signaled that significant work remains before talks can take place at the highest level.
Big gaps remain.
It indicates a continued, pretty fundamental divergence on key positions, and it highlights the profound challenges ahead for any high-level talks that are seeking a genuine, lasting settlement. There's a clear push and pull happening between internal NATO politics, U.S. foreign policy goals, and Russia's stated red lines.
That is a lot to unpack in that conflict alone. Meanwhile, shifting to East Asia, North Korea's Kim Jong-un returned home after a summit with China's Xi Jinping.
Yes, that meeting took place.
Where both leaders reportedly pledged closer strategic cooperation.
What's the wider significance of this sort of strengthening alliance for regional stability?
Well, this strengthening alliance between North Korea and China is, I would say, deeply significant for regional stability.
Really, how so? It really solidifies a strategic bloc in East Asia. It reinforces their existing ties, and it creates a more united front, potentially, on certain international issues.
Counterweight, perhaps.
Could be seen that way. This closer cooperation could certainly influence geopolitical dynamics across the region and maybe even beyond. It could potentially challenge existing power balances and make diplomatic efforts by other nations like the U.S. or South Korea more complex. It's a very clear sign of these concerted efforts to bolster specific partnerships in what feels like a rapidly changing global order.
Okay. And finally, one more flashpoint. In the Caribbean, the U.S. reported Venezuelan military aircraft flying near a Navy vessel in international waters.
An encounter at sea.
Underscoring, the report says, ongoing tensions in the Caribbean. Why do these seemingly maybe minor incidents actually matter so much in the larger geopolitical context?
Yeah, while an event like that might seem isolated or just a small incident, it's often symptomatic of persistent regional sensitivities.
Underlying issues.
Exactly. Underlying geopolitical tensions that continue to simmer in places like the Caribbean. These incidents, they serve as reminders of ongoing strategic posturing between nations.
Testing boundaries.
They can certainly be interpreted that way, as tests of resolve or boundaries. They underscore that even seemingly minor events can quickly highlight much broader strategic concerns and power dynamics between nations, especially in regions with historical or ongoing rivalries. They're rarely just random.
Wow. We have really covered a vast amount of ground today, haven't we?
We certainly have, from trade details to global strategy.
Yeah, from the intricate dance of trade tariffs, the precise calculations in energy markets, all the way to the delicate dynamics of international diplomacy in these regional flashpoints. It just goes to show how truly intertwined everything really is. You know, a tariff here, a wage report over there.
And the ripples spread.
And the entire global picture subtly shifts. We really hope this deep dive has given you a clearer, maybe more nuanced picture of all these complex forces at play.
Yeah, helping you feel more informed and perhaps a bit more ready for whatever comes next.
Exactly.
Absolutely. These global currents are just constantly shifting, aren't they? And understanding their interconnectedness, really seeing beyond the immediate headlines to the deeper implications. That's so key to navigating the world today.
Indeed. So as markets remain finely balanced with that key U.S. labor data still on deck.
Still waiting for that.
Alongside upcoming OPEC Plus decisions and these continued geopolitical flashpoints across several continents. Here's something for you to think about.
Okay.
What one development out of all this do you think will have the most unexpected ripple effect on the global stage in the coming weeks? Something for you to ponder and explore further.
A good question to mull over.
Thank you for joining us for this deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.